Well, welcome to today's FS Club webinar. Today we're going to focus on San Francisco and London, bridges of technology and finance. As you can see, the team couldn't resist putting a picture of the Golden Gate Bridge and Tower Bridge. And today we're going to discuss the links between them with Jeff Sweeney here, who is dialing in from San Francisco. Now, all of you, I suspect, know who I am, Mike Minelli, chairman of many of these sessions. And it's a real delight to be able to host these sessions because of, frankly, our sponsors. Our sponsors are wonderful, allowing us to range widely and freely over technology, economics, and finance. And today is certainly about technology and finance, as we're going to be exploring the bridge between San Francisco and London, which is clearly very, very much a technical one. Now, Jeff and I just wanted to kind of kick things off with two very short, sharp polls to sort of see where you in the audience fit. The first poll is going to be, have you ever been to San Francisco? Yes. I know it's a Scott McKenzie song, and we could talk about that for hours, but I've got a quick little poll here about have you ever been? So if you don't mind, I'll leave this open for about 30 seconds. If you have a look on your go-to dashboard, you should be able to see the poll itself and start completing it. Wow. Well, Jeff, 84% of people voted, and you're not going to believe this. 89% have actually been to San Francisco. So that is a real eye-opener there. So just have a quick look, just showing everybody here the poll results, which should come through in a split second. There we go. Yeah, so and try to stop there. Now, as you might imagine, this is a talk about business. And so Jeff and I would like to ask you a second question, if you don't mind. Have you or your company ever done business between London and San Francisco? So again, another quick poll out there for the audience. And I must say, it's a very alert audience. As I've noticed, the last poll was pretty much finished in 16 seconds. And this one is going to be finished in, we're slowing up, folks, in about 20 seconds. But let's have a quick look at those results. And actually, a high percentage of people, 61%, they or their company have done some sort of business between London and San Francisco. So a good flavor there of what the audience is about. So I'd like to turn, if I could, I'm going to open with a few slides, really, about San Francisco's performance as a financial center as viewed from London. The first thing is this slide shows San Francisco's rating in the Global Financial Centers Index. On the left, we've got the rank, and on the right, we have the rating. So the rank is where it stands in ordinal sense, and the rating on the right is its actual score in the index. What you can see here on the right is good improvement over time. And on the left, it's been bouncing around a bit in terms of the ranking. But do remember that in the 15 years that the index has gone, numbers of cities being rated have jumped from about 55 to 110. So it's been holding its relative ranking position, frankly, quite well, particularly against the Chinese centers who've been surging the last 15 years. Second thing we might have a look at is San Francisco in North American terms. And again, when the index started, a lot of people were surprised that we had San Francisco there at all. Clearly, there was wealth management and a bit of banking and a bit of insurance and some very good connections with the West. Jeff will be going into a lot of this. But as you can see, San Francisco's performance has been extremely strong. And arguably, at the moment, it is the second center in North America, which I think might surprise a lot of North Americans who would assume that that was Chicago, or if they're in particular sectors like insurance, strengths in areas like Minneapolis. We then have a quick look at San Francisco in terms of its connectivity. And this chart doesn't draw out fully, or I'd have to pull it around a little bit to show you some of the richness in it. San Francisco is clearly a gateway to Asia. The highest ranking centers for San Francisco in terms of connectivity and financial markets is very, very much areas like Seoul, Guangzhou, Shanghai, Shenzhen, and Beijing. And very interestingly as well, the next largest link heading east is London. So there is some very strong substance to this bridge. San Francisco is very much a bridge between the two. Now, as we turn into what you're probably expecting is, yes, but where is it in fintech? And I think Jeff's going to give you a rich view of how fintech is viewed from San Francisco and the related regions like the Valley. It shows up quite strongly. And over the years, what I've noticed is that the FANG, the Facebook, Amazon, Alphabet, Netflix, and Google Group, except I think I just doubled up there, Apple and Amazon, that's right, Netflix and Google. The five FANG are obviously deep into payments, and we've got a number of other payment systems floating around the Bay Area. But it's not just payments. San Francisco actually has a fair amount of deep plumbing, big data, and AI services all being used in fintech areas. Another interesting bit, particularly with the U.S. elections 35 days away and viewed from an overseas position, is what about green? And obviously, all eyes have turned. I must say, the talk in London this week has been most clearly about President Xi's announcement of net zero by 2060, and hopes around Western Europe, at least, are certainly turning to what will happen in the U.S. elections. San Francisco, in a continent that is not particularly known for green, North America turns up extremely poorly in the Global Green Finance Index, is nevertheless the leader. And the ratings over time for it, both on depth and quality, are extremely good. And the mean of assessments for it is also extremely tight. So we're finding that San Francisco is well regarded in that area. Amongst the other North American centers, clearly it's going to have to slug it out with Montreal, Toronto, Vancouver, basically Canada. But within the United States, San Francisco has an enormously strong position. And very finally, I might take a quick look at where San Francisco features in our Smart Centers Index. This is a rating on wider technology. This is not just fintech, so it covers the gamut of technologies from biotech through hard tech and on out. And again, against the New York area, which oddly does extremely well. Most North Americans would assume it was sort of Boston or Dallas, Fort Worth, but actually New York is the center for a lot of this action. San Francisco is right up there as well, currently ranked number 4 on creative intensity and 5 on delivery capability. So a particularly strong showing there. So that gives you kind of a snapshot from abroad. But you're not here to hear me. You're here to hear from our guest. Jeff's where the action is. He's got a law firm, a law background and a firm which is doing a tremendous amount of capital raising and funding on both sides. But he has a very strong London office as well. So Jeff, with no more ado, they can read your CV online. In fact, they read it when they decided to sign up. So I'll leave it to you. The floor is yours, sir.
Well, thanks very much, Michael. It looks like I need a new headshot. I need a post-COVID headshot there, which actually I'm doing tomorrow. Well, thanks for that. Interesting to see the rankings there, especially since we're down in the weeds in San Francisco. And I wonder if the FinTech ranking is a little bit low because the technology diversity is quite high in San Francisco, so it may affect that a little bit. So U.S. Capital and myself, I've been 45 years in finance, from running technology-based aerospace manufacturing, made a change in the late 90s over to finance, sold that business and capitalized U.S. Capital. So it's been about 20 years in pure finance. But the crossover is we're technological innovators in aerospace back in the day when manufacturing tech was the leading efficiency producer, and that no one remembers that. But then we went over to finance, so we've really applied a technological approach to finance and process in finance, and so that makes us what I consider to be one of the leading fintech investment banks. And we use a lot of market tech and a lot of technology and processes for analyzing middle market and lower middle market credits, which is unusual. All those things are generally bespoke spreadsheets, analysts and spreadsheets, but we've added a lot of technology to that. So we're almost an old school, fintech merchant bank, right? So we have assets under management. We registered with the SEC as an asset manager. We manage funds. We have a equity fund. We have a couple of credit funds. And then under our asset management, we have a wealth management division where we manage individual wealth with a focus on alternatives. And then we have and that's under the SEC, under RIA, they call it Registered Investment Advisor. Then on the FINRA side, we're licensed to raise capital. So we use our regulated entity, U.S. Capital Global Securities, to raise capital for our funds, and also we can raise capital for other people as well. And we're licensed to syndicate deals, so we can raise capital, participate in bank syndications, or lead a SPV with a club of co-invest family offices to do deals. But we're licensed to do that. We have a mirror image over in London, so we're FCA over there, and we have the same rights in London, which is we consider. So that you start talking about the bridge, and we consider, the U.S. is interesting. I mean, I like you have a litigation background because it's an interesting place, right? A lot of people don't, they're a little leery of the U.S. and generally people are leery of other countries anyway because it's difficult to understand the complexities of the tax law, the legal law, and things like that. So we consider our London office really a gateway to the world, right? London, the regulation's a little lighter touch. We have more options for referral fees and things like that than we have in the States. And so it's been a great gateway for us to originate clients that want to raise capital in the U.S. under our umbrella, or we distribute securities in Europe, and vice versa to find investors for U.S. opportunities. We can look throughout Europe and Asia for that out of London. It's really turned out to be I've got a great MD over there and a team, and it's a great place. I have a house there, so I used to go to London about every 5 weeks. But I've been trying to get back there since February. But maybe November. I may be back, hopefully November. It was October last month, and now I pushed it off to November. So the profile, we want to talk about, since I'm pretty well versed, but I've spent decades in Europe and decades in London, whether it's friends or business. So I speak, somewhat culturally both languages, right? Both American and European and British to some extent. I was laughing. We have a portfolio company in Paris. I got on with their controller yesterday. I said, well, we were kind of had an issue, right? I said, well, look, U.S. and Americans, we get along pretty well because we're a little bit, kind of asses, both of us. So that's why we get along. So anyway, but I do understand different cultures, and I don't have a pejorative, what would you say, a pejorative view that the U.S. is something special, right? I think all countries are special, and I really believe everybody has a different culture, and I don't believe in kind of an endemic American superiority, which it also creates a better bridge for talking to other people, because I respect other cultures a lot, even though if they're different, their negotiation styles are different, and I just respect the approach. And so I come from that position. I come from, Americans, we're kind of jerks, right? That's just what we are. And then you're dealing with somebody in front, you guys are kind of jerks too, so I'm okay with that, right? And you're going to have to be okay with us. And that's
when we were chatting, Jeff, you were pointing out that one of the things in San Francisco is a culture of young, unsophisticated money. That was, I thought, an interesting point.
Yeah, I wanted to get into that. So we started talking about cultural differences, right? Whether it's how you negotiate a deal, how you approach, or the legal systems. And then you talk about the investor class and the investment class. We have a lot of institutional investors in the U.S. And then in San Francisco especially, there's a cultural difference in the investor class that I perceive. And in London, it's been a financial hub for generations, hundreds and hundreds of years, right? And so there's a lot of older type money and institutional type view of capital. San Francisco is not like there's not a lot of assets under management, under formal management from managers. A lot of single family offices and wealthy individuals, and a lot of new money, a lot of newly minted millionaires from the technology booms. So it's a different. There's a different investor class out here. You have some big guys that have had massive exits, right? And then you have just a high number of accredited or sophisticated investors from their wealth standpoint, like millions of dollars of wealth. But they may not have an advisor. They don't do balanced portfolio. They made their money in tech, so they're really looking for that next tech home run. It's kind of a little bit different than London. Is a little more formal. Family offices, better organized, and older money. That's my view. So the capital raise activities, aside from Silicon Valley, where you're back at the institutions, the Sequoias, and these guys. But a lot of the capital raise happens. It's meetings, it's social, it's parties. I've got a much younger senior partner, and he's screwed into the network quite well just because of his age, and the demographic is all 30-something guys. They're starting to get old at 40, and so he's pretty screwed into that network. So that gives you an idea.
Yeah. Well, it's interesting you picked this quote. The audience won't believe that as sheriff of the city, I didn't insert this. I can attest that Jeff really picked up on the Lord Mayor's visit last December to San Francisco. And as the bullet point here points out, the new research shows that the UK is the first choice overseas market for North American fintech venture capital, but likewise San Francisco in return. And for the audience who's hanging on tenterhooks, I'm delighted to say that presiding over the Lord Mayor's election today, William Russell has been elected for an unprecedented second term, or almost unprecedented since the late 1800s. So there you go. So tradition meets new money, I think, is probably the phrase here, isn't it, Jeff?
Well, sure. Look, this is the Wild West out here. We're kind of enamored with British culture, language, the royalty, and the history. There's a strong relationship between the two countries, and the U.S. is very favorable towards the UK. I mean, we like the music, we like the people, and the language. Come over here with a British accent, and you own the scene. I wish I could say that for an American accent in London, but certainly over here there's a preference, and also the similarity in languages helps as well because. In America, we only speak two languages: good English and bad English, right? And so it's a barrier, right? Because we're physically isolated from the rest of the world, and so there is a language barrier, and the Brits, although they speak a form of English, is a great bridge for that. And so there's a lot of reasons for that link, and then with the similarity in technology, I mean, London's really emerged as a real tech leader. Some of those stats were very interesting. I think it's a hub for talent, much like Silicon Valley is in the U.S., let's say, and also internationally. I think people want to go to London anyway, because it's a world city. It almost doesn't belong to the UK. It's a world city. People want to go there, and if you're creative and in tech, you want to go there. And I think that's what builds a strong base.
So you're fairly bullish on London, despite things like Brexit, which I remember from our warm-up call.
What I say, I mean, I don't have a dog in that fight. Right? I mean, it is what it is, and so I just, we just deal with it. But look, U.S. Capital Global, we do really well in chaos. So we don't foster it, but when it happens is when we do the best, right? We're creative, innovative, nimble. Those are all the things. I was laughing with my partner yesterday. He was talking to me about some distressed deal in the Midwest, some tech airplanes or something. And we're looking at that and we go, well, what? It's in bankruptcy. Okay, we got to do some dip financing, do things like that. And he said to me, he goes, well, I haven't been thinking about that stuff for about 8 years. Well, it goes the last financial crisis. So, but we like chaos. So, I mean, Brexit is what it is. We didn't cause it. We're not going to fix it. And it's almost not polite to have, I think, pretty polarizing topic. But however it shakes out, although we do share that confidence that it's going to work out okay. At the end of the day, it'll work out. And I'm not I really, if I have to fall on one side of an issue or another, I never fall on the doomsayer side.
Now, you were going to share with us a couple of case studies of things that U.S. Capital Global has done that exemplify that bridge. And
yeah, what was that's a good one. We have Miras. Now that's an interesting transaction. This is a real estate tech, a sustainable real estate tech company, right? Their DNA is real estate development, and then early on they found, and their heart is in it. They found that if they had more sustainable or community friendly projects, they got approval easier. Well, it also corresponds to their feelings as people, right? So they started doing more sustainable projects and injecting more sustainability into condo conversions and developments, things like that. And once they got a taste for that, they said, you know what? We're going full sustainable. I mean, we're not going to be not 1 foot in, 1 foot out. We're going to do full sustainable. So they developed a tech stack for doing a green bond certification and assessment in conjunction with Ernst & Young. And they also developed technology for monitoring green performance ongoing during construction, for looking at the construction inputs and the carbon footprint of the construction and post-construction maintenance to develop a timeline of when a project turns the corner and is carbon negative, right? Because you get a carbon load in your Tesla car. I have a Tesla. You got a carbon load on that thing just getting out of the factory, right? There comes a point where it switches and it's a carbon neutral project. They take the same approach to real estate. Do we import the Italian marble up to our project SPART up above the Arctic Circle? What's the carbon input of Italian marble, or should we use Norwegian granite down the road? So they make all these assessments in order to reduce their carbon footprint. So they've got a lot of technology, a real technology stack there, and then which has got them a very interesting project with that Spark Hotel, which is on I think it's on a glacial lake right above the Arctic Circle, the little glacier, of course. So, okay, interesting. They brought me in because we're from the U.S. and we raise capital. We've got a long track record. Plus, I've been vegetarian my whole life. I do a lot of yoga. I mean, it's California, right? We don't like sleep on issues. We meditate. So it's
You've got some pretty impressive online poses. I'm sure a few people could be Googling
what's that. But I've done yoga for years and years, and I mean, we just, I'm typical California, probably maybe atypical because I'm always pretty extreme in what I do. So if I go green, I go pretty green. So anyway, so now we're in a relationship. We designed their financial products, the certification, and then classic example. Now I get a call like a week ago because we market a lot. I get a call from a Palo Alto group that had a big exit. I'm laughing with them as I said, well, you had a problem like 2 months ago, and that's when are we going to exit this deal? And then now you have a problem today. Oh my God, we exited this deal. Now I have a pile of money. It's a whole new problem. Now I've got to deploy the capital. So I meet with him tomorrow at lunch, classic San Francisco, right? Lunch at the Battery, which is unlike London. The Battery is like the only club. It's a very good club. It's actually London quality, but it's like the only one in San Francisco. So I got lunch with him, and we'll talk about it. Very interested in Miras. They like real estate. They like tech. So it's a kind of a classic blending of like a European deal with a local investor, bridged or facilitated by us, who we like to think we've got a foot on both sides of the Atlantic there. Clarify. Well, Clarify is an investment advisor, right? And so we raise a lot of money through the advisory network. They've allocated quite a bit. They're institutional investors, so they have advisors and maybe FCAs in the U.S. They specialize in alternatives, which is all we do. So we really have alternative growth equity, which is really an equity position early or late stage, or you have alternative credit, which is a kind of non-rated private credit, and we focus on not necessarily non-real estate correlated. We have some real estate, but there's a real demand for non-real estate correlated credit, like convertible notes in growth companies, non-real estate correlated credit. So Clarify are good friends of ours, and they allocate a lot to us because they get this alternative assets under management. Then they're looking for deals. They have to find trusted people who build product. We build product, right? Investment product that meets regulatory standards. And so they've allocated a lot to us in both growth equity and fixed income. And so that's another way because once we get under management, then we do international distribution, right? So you can have U.S. investors in a alternative investment structured by a U.S. company, and then we can allocate offshore. Part of the mandate of the funds is, it's U.S. or offshore. So that would be the good connection between a direct invest, high net worth, liquidity person in what we call a rifle shot into a deal, right? And then we have an advisor network that will allocate to our funds under management, and then that way we can carefully choose investments both in the U.S. and worldwide.
Fantastic. Well, that's a really good warm-up, Jeff. We've got a number of questions out here from a lot of people. Folks, if you want to get your questions in, do send them in rapidly because we've only got about 20 minutes left, not even. And I'll try and feed them into the conversation. Please use the GoToWebinar facility. Don't email me. I'm here with Jeff and you. Anyway, let's get cracking. We've got a few minutes. Bob McDowell's out in the Channel Islands, and he's got a cheeky one. Maybe a quick answer on this. How would you advise the young, unsophisticated money in San Francisco to become more sophisticated?
I don't think you can. What you can do is you just kind of build trust, and you present, you have to know what they want to do. They want to do a rifle shot deal, then you build that trust and you show them allocations, right? Because here's the problem. The problem is a lot of these guys, family offices, they really want to do co-invest. They think they want to do co-invest. They don't want to be under in a management situation, right? It's the U.S., it's the Wild West. You don't really want an asset manager, right? You think you can do it yourself. So the problem is but they want to be quiet about their money. So they want a lot of deal flow, so they have choices, but they don't want to really advertise they've got a big pocket full of money. So it's really the dilemma. So you end up building these relationships, and then we have a whole database, so we know what their appetite is, and then we bring them transaction, much like I said, Miras. I bring them a transaction that I know fits their interests, and then they can do an individual deal. So that's how you deal with those guys. You're not really going to change their mentality.
At least it's more of a broker mentality, isn't it? That you're really an active broker, whereas to some degree, and I say only some degree, we're a bit more roadshowy and semi-organized. Pluses and minuses, both of those models. Yeah.
I think what we call, well, of course, if you're licensed, it's you're a placement agent, right? And that implies a broker. Now, I love brokers. Our lifeblood is brokers. Right? People bring us deals all the time. We love those guys. We pay everybody like clockwork. But when you're regulated, you have to take responsibility for the investment. That means if there's something bad about it and you sell it, you're going to pay a massive fine and get barred from securities. So it's a placement agent activity, and that does push us up the tier a little bit because we don't promote deals. We only are placement agents for deals that we're involved in. And from a regulatory standpoint, we have to. So there's a slight distinction there. London, on the other hand, I don't want to beat this one too much, which I love London, but they have introducer agreements where you can be an introducer and introduce an investor, step back and collect a fee. U.S., no way. You cannot do that. It is impossible. It's impossible to be an introducer for securities in the U.S. and get paid commission.
Yeah, I'm delighted you highlighted that distinction. It's an important one that many people forget.
But introducers are valuable. I'm not prejudiced. It's just a differentiation.
Now, Abradat Kamalpour, who was very instrumental in setting up this connection, is asking, what stage of FinTech startup should attempt to raise investment in Silicon Valley? Is Series A plus better than early stage? Any thoughts on that?
Sure. I mean, you have to define your terms, right? So you've got seed stage, right? Seed stage, friends, family, grandmother, you got to do it yourself. If you go try to do a seed stage, that's pretty tough sledding, in my opinion. We can't touch it. It's too small. Mm-hmm. Then you're going to get a Series A. Now you get up to Series A and you want to deal with the small VCs, right? You got those three guys and a dog. They've got 10, 15 million under management, and you're going to pick up a quarter, $500,000 from these guys. Then the next round, you're going for an A round, and maybe it's going to be 3 to 5 million. Now down to 5 million, we'll start participating in a institutional round or a high net worth round and broadcast the opportunity. So again, early stage, seed stage, friends and family, founders round, right? Then you have that. Venture round where it's the small VCs. I love small VCs. They don't get enough good press. A lot of them forming now. That's a great place for that $250,000, $500,000, plus they'll help out a little bit, right? And then you scale you up where you need 3 to 5, then you're ready for prime time. You can go walk around with your hat in Silicon Valley, and that works. But watch out. They won't sign an NDA. Now they have a portfolio company. I was talking to a guy the other day. They have a portfolio company. You go to Sequoia. They have a portfolio company that does just what you do, right? And they're not going to sign an NDA. So they talk to all these guys trying to raise money, and they understand their business model. And I'm telling you, there's mind share in the back room about what you're doing. If you've got a tweak and more innovative, that's going to get spread around because they will not sign an NDA. We won't even talk unless we have an NDA. We want to protect both sides. So there you go.
Now, coming the other way, got a question. What more can London and the UK do to attract funds from San Francisco area into European deals?
Well, we act as a bridge. There's a few other guys. I mean, you almost need a relationship in San Francisco, right? Now we have an office. So we have great relationships in London, facilitated by our office there and me going all the time. And it's a relationship business, right? So you need some kind of relationship, either us or a reasonable facsimile, and get a relationship going. I see guys come up, fly over, and they make the rounds, and then I don't know that's a really successful strategy. And I'm not just pitching my own deal. There's other guys like us, and I think you need to develop a relationship to distribute a security here. It's hard to just show up and spend a week. You take a lot of meetings. It's quite difficult. And it's the same thing for me. I mean, it's to show up until I got an office years ago and license. It was interesting, a little bit random, but now you have to have a solid footprint and a solid relationships to raise money.
On the concepts, on relationships, the concept of mentor is very big over here. It's been growing, at least in terms of importance. And I do find it somewhat off-putting as people meet you and at the end of the meeting, would you be my mentor? And you're like, whoa, just hang on a minute. But anyway, Hugh Purser is curious, how would you compare the role of the mentor between San Francisco and London, or is that not a question for you?
Well, we see everything, right? We see more deals we see billions a year in opportunities, just literally 6 billion. So we see every configuration. We see things that hopelessly will never work, and then we see things that are really good business models. Generally, when you ask somebody to be a mentor, you're really saying, will you be a seed investor and help us out? Because you don't usually take a mentor unless they have skin in the game. So, but that's a great model. So that's why those little VCs are great, or friends and family, founder rounds, where you end up with an investor that also has an expertise in the sector you're in, maybe a little more seasoned, maybe had a couple of exits. There's a mentor for you. Or you get a small VC, they put some money in, and they one of their staff has expertise in your sector. And it's kind of the investment comes with a mentor.
Very good, very good. Got a question about Bob McDowell again on culture as well. Why do the young tech entrepreneurs sell out quickly? You may not agree with this, but why do they sell out quickly? Is it boredom, lifestyle changes, limiting staying power, other reasons?
Why do they sell out quickly? Is that really a thing?
Well, that's Bob's impression. Maybe that's not yours.
Sell out quickly, right? I think the trend is, at least over here, the trend is organic growth, less VC money, and found and hold. That's the trend. That's the trend I see. Actually,
can you give an example or two of that?
Facebook, develop and hold. a lot of these companies, founders are still, look at the big guys, Twitter, these guys are still have a lot. Then you look at a model like Box, right, or
Yeah.
Dropbox. The guy has like chump change shares, right, because he got VC to death. So I think the model of I think the model of going to a big VC, not signing an NDA, and then once they get in there, they're going to displace you.
Mm.
And I think this organic growth, a lot of people are a little more, it's kind of a back to nature movement in business. And they founders want to take, diverse capital, not lose control. They've seen a lot of, like the anecdotal success, but they've seen a lot of guys getting thrown out or crushed out of the
Yeah. Anthony Abel loves your definition of "you will be my mentor" equals "will you be my seed capital, seed investor." I mean, on that front, does this idea of organic growth signal kind of the end of the fandom of the unicorn?
Well, you want to organically grow to be a unicorn, right?
Yeah, yeah.
I mean, that's what you really want. There's a lot of interesting models now, like Spotify I wrote a whole paper on that. Very interesting model. Founders had a more, you would say, compared to Napster, for instance, you had a more or a more business model for music, right? They actually paid the artist to play the music. And they raised a lot of secondary money. I don't know what I can't speak to how much the founders ended up retaining in their company, but they raised a lot of money organically, right? A lot of investors were in it. Then they had a really active secondary market. People bought and sold Spotify shares in the secondary market quite a lot. And then they self-listed on New York Stock Exchange, I think. I'm not sure what exchange they're on, but they self-listed. They didn't raise any money. They self-listed to get liquidity for their investors. Now, I don't know how the company's doing. I don't track those guys. But the process of the organic growth, diversified investor base, secondary sales, boosting the value and establishing the value, a private listing or a self-listing, right? Not raising new money at the listing to provide liquidity for the investors. Very interesting model. Very interesting. Ethical is not the right word, but it's an approach. It's a respect to investors approach that in artists. I think the corporate culture, at least from not studying it too closely. I like the way those guys are thinking because we think like that way too. Here's the table. Here's everybody at the table. We need to do a deal that's good for the investor. It's good for the founder. Good for the bankers. We need to make sure everybody at the table it's the right deal for them. And it doesn't always work that way, or not everybody has that.
During our warm up, Jeff, you had some really interesting insights I felt on debt financing and notes and things. And he was actually interested in what is the current role of debt financing in San Francisco tech today.
Convertible notes are king.
You want to elaborate on that a little bit? Because some of the audience may not be familiar with the importance of them.
Note is, you can, it's a little bit, it's a security, right? And so, but it has you've got an equity upside if you want it. So you might put $1 million into a deal. It may accrue at maybe 8-12%, depending. Starts to accrues interest for 3, 4, maybe 3 years. And then you have an option if the company takes off to convert that million plus accrued interest to up to maybe 25-30% discount on shares. You have conversion right. So that's a very attractive product. It's like super preferred equity in a sense because you've got liquidation preference because you're a creditor in case the wheels come off it. But that's a very interesting model. We do a lot of convertible notes off our balance sheet.
Are you finding that is also of interest to your European clients?
Yes, we had some Norwegian guys go into our Miras deal on the convert, and also we've got Takeout Group in Denmark that they have we seeded it with a convertible note, or it actually was an operating entity, so we didn't seed it, but we put the first convert in there. And then we've got a Lithuanian institutional investor that's looking at taking up the rest of that $5 million round, I think.
Okay.
So it
We're
is.
coming sadly to the end of time, so I'm just going to a couple of questions if I could squeeze them in here, if you don't mind. Looking ahead, Jeff, and leaving the bridge aside, Katarzyna Alexander would like to know, what are the emerging financial centers or markets you view as particularly good prospects in terms of future cooperation? So are you turning south? Are you turning to Africa? Are you turning west to China? What do you see?
I think the U.S. is one as a is probably one of the world leaders in financial products, for good or for bad, right? I mean, we crashed the whole world in 2008, right, with our creative financial products, so that's a bad thing. But we're innovators in financial products, in securitization, in even legal around rights, right? So what I'm seeing is people come here to get financial products designed, right, and they'll take them back to where they live. Like we've got a Latin American green energy bond fund. Guys come in, want to raise money here. If it has a U.S. ticket on it, then they can raise it easier in their country. You can run it through Delaware law, which is very friendly, almost like the Channel Islands kind of thing. So I think as an innovation, I think people come here to build product and take back home. I mean, you don't go to Singapore and build a convertible vehicle. It's awkward. They do it somewhere. And there's certain things around interest in the U.S. that's very interesting. Here's a little known fact. You do an interest-based only product in the U.S., there's no tax. There's no tax reporting. For offshore investor, there's no tax reporting. There's no tax. There's no nothing. You send the money, and then it's the honor system to report to your domicile. Equity, on the other hand, you want to use an offshore vehicle because there are some complex tax laws in the U.S. Not burdensome, but they're just different. You have to understand them, and people don't want to do it. So when it comes to equity, it's a little more awkward. We do offshore structures for equity, onshore for debt. And we have London office coming to our onshore debt equity and doing a deal in Europe.
And what would some of your favorite offshore centers be for those types of structures?
Nordic country, I like. Well, as far as allocations, Nordic country, we've got a portfolio company in France, Italy. For structures, we'll use BBI, Cayman maybe. Cayman's getting a little blown upon, but the BBI is a good place for that. But Cayman's okay.
Okay.
It's a nice domicile. I'm not as familiar with the Channel Island things. It's my own lack of expertise there. I'm not casting disparity on it.
A final one, just turning locally. Press is press. But sort of a two-part question here from both Karen Saraki and Tim Coleman. Karen Saraki is wondering, strongly, it's a shame that San Francisco is turning into a dump. What are people going to do to make it better? That maybe you might want to react to that and some of the press on that. But Tim Coleman has a sort of more positive question. I studied part of my university course in San Francisco 10 years ago. I've heard it's changed a lot since then. How do you think San Francisco's position as a finance or tech hub will cause it to change over the next 10 years?
We're having a webinar on that in a little while. There's been a change. I think we perceive a shift in thinking, and it's probably going to happen in London too. Where in San Francisco, aside from it being a shit show, I think is what she's trying to express. I think it's going to become a hub for kind of executive sales hub, but they're going to send the coders out to the suburbs. In London, I suspect it's going to happen the same way. People are always going to want, it's expensive. You want to be insulated when you go to San Francisco. It just takes money, right? So you're going to get the higher level guys who are still going to go there to do deals, to meet, to figure things out and hang out there because of this income disparity thing that's happening, which is a whole other tragic political outcome and not exacerbated by COVID. But you're going to see that as a hub, just like London, and then they're going to push those coders out to, Portugal, Lithuania, and then you're going to have the corporate offices in the city center. I think San Francisco's the same. They've already done that. They're already pushing that, a lot of vacancy in San Francisco.
Well, Jeff, I'm getting a lot of remarks here thanking you for your contribution, which is normally a sign the audience is telling me that it's time to
I
disappear.
always
Uh,
apologize for being so candid.
no, it's excellent. I really appreciate your candor and also dialing in at what is an early hour. If you can give me just a second, I'd like to give 3 rounds of thanks, if I might. First round of thanks, as ever, and warmly to our sponsors, a vast range of people who allow us to, as I said earlier, cross freely across topics of interest. I'm hoping that this bridge between San Francisco and London strengthens, and hopefully we'll be seeing much more of this type of bridging encounter. Folks, we've got quite a few webinars coming up this week next, and I might highlight a few. Tomorrow morning, or sorry, tomorrow afternoon, we have the Magic Money Trees. Benoit Lallemande is going to be dialing in from Brussels and giving us sort of the inside look at what's going on in Brussels thinking on future EU economic policies. Something I've been dying to have for ages is going to be fascinating. Saeed is going to talk to us about long lessons in the religions of the book Teach Modern Finance, and a good look at Abrahamic lending. And it's richer and deeper than you think, and is part of a series that we'll be doing on the religions of the book. We also have an institutional investor's views on the use of share placements and share plans, sorry. And finally, a very unusual one. We're going to be exploring one of our favorite financiers, Sir Thomas Gresham, as you'll know, 1519 to 1579, of which your chairman has written copiously and helped sponsor a book. But Ian Harris will be looking at what was real tennis doing at the same time. Don't ask, be there. And if I may then, Jeff, it falls to me to thank you. In this era of COVID, I'm unable to open up the copious cells of applause. But in truth to you, of all people, given your yoga and your meditation, I have before me my Korean karmic clapper. And I shall, on behalf of the entire audience, thank you appropriately. We really appreciate your insight. Thanks for spending your morning and our afternoon with us.
Yeah, thanks so much. It's just a pleasure to be here today, and great questions. Appreciate it.
Hope to see you again soon. Thank you.